Hello, everybody. This is Reese Codes, and today we're going to talk about options. We're going to talk about what they are and some equations about how to price them. So, an option is a type of derivative, and there's different types of derivatives. There can be futures, there can be swaps, there can be perpetuals, and a derivative is basically just a contract that gets its value from an underlying asset. And when I talk about assets, that could be anything from a stock, it could be a commodity, it could be a fiat currency, it could be cryptocurrency, it could be uh, a bond, it could be anything that's traded on the market. And the thing about an option is that it locks in a price, so the buyer can buy or sell the underlying asset, right? So there's two types. There's a call option that allows the buyer to buy an underlying asset at a set price. That set price is usually called the strike price. And then there's a put option that allows the buyer to sell the underlying asset at a set price. And like I said, options are a contract, and any contract they have a term. So let's say I have an option. Let's say I'm looking to buy an option, and it's an option. It's a call option on Apple, right? And it's for 3 months. So what that means is at the end of that 3 months, I can either buy or sell those Apple stocks if I get that option. If I choose to get that contract, I can either buy or sell them at that end of that 3 months. And there's different styles. There is an American style and European style. So in American style, there is no obligation to do anything. And it's more flexible because you can even trade it before that term is up, right? So let's say I buy that option I'm looking at on Apple stocks, the 3 month one, and I buy it. What this means is that I can call that in at any time. So I don't have to wait 3 months, the term of the contract, to go call that in. I can call that in 2 weeks from now, or a month from now, or 2 months from now. And even after the term is up, right? So I buy that option. It's a 3 month term. And in the 3 months, I look at my sheets again, look at my money, and I'm like, you know what? I'm not gonna buy anything. This is not a good deal for me. So I can walk away. And walk away, there's no penalty at all. So American options are very flexible. European options, on the other hand, they're more like you would think of a contract, right? I buy that call option. Let's say it's a European style now. What that means is that I can't trade. I can't call that underlying. I can't buy the underlying asset before the 3 months, right? I have to wait for 3 months. At the end of the 3 months, I have to buy it. And there is no walking away either, right? There, on the American style option, you have this flexibility to walk away at the end of the term. I have this option. I can look at my money and say, hey, I don't want to do that. European style, you have to buy it. There's a couple of terms that people use when they're talking about options. Out the money, this means that the contract's not profitable. In the money just means that the contract is profitable. And then on the money means the contract is breaking even. Excuse me, I'm kind of sick right now, so excuse me for the sniffles. Priced in an option contract. So this is a very big subject. We'll go over some simple ways to do this, and then I'll talk about the more complex, more realistic ways that people do this. So, an option is only as valuable as the underlying asset, but the underlying asset is changing in time, right? The price, as the time goes on, the price of that underlying asset can rise or fall. But you can always generate the intrinsic value for an option by using this formula right here, right? Excuse me. IV stands for intrinsic formula. S symbolizes the stock price, and K is for the strike price. Like I said, the I think that's a holdover from baseball. So that's the equation for finding the intrinsic value for a call option. For a put option, is a little bit different. You have to subtract the strike price from the stock price. But this is just a snapshot in time, right? Because like I said, the underlying asset is changing in price as time goes on. So you can put this equation in there and you can get the snapshot for the day. Like this is what it is, right? This is how much value this option has as of today, or even as of this stock price, because the stock price throughout the day may go up and down. So this is a very limited view of how to price things, and it's not a realistic view of how to price things. Like I said, the actual pricing is very complicated. And from my research, there's about 4 main methods that quants use to kind of price options. One method is called binomial pricing, and I'll do videos on all of these in the future, more in-depth videos about all of these in the future. But like I said, I'm still working my math muscles up here. It's been a long time since I had to look at advanced math, so I'm still kind of not going to rust off the wheels. But we're talking about option pricing, realistic option pricing. First, it's going to be binomial pricing. That's one way to do it. The second is going to be Black-Scholes-Merton, using the Black-Scholes-Merton equation. And Vertesium is another YouTube channel. They did a very good video essay about this equation, and they called it the $1 trillion equation because that Black-Scholes-Merton equation is like ubiquitous across all of the derivative markets. And I think they estimate all of the derivative markets as being, worth $1 trillion. So that's why they call it the $1 trillion equation. The third way is Bayesian statistics. So that's another way that quants will use math to kind of try to predict the future, to see what the future holds for this underlying asset, and thereby also pricing the derivative. And then the last way is Brownian motion. And the original context for this is like gas molecules moving through the air. And they just apply that to stock prices. And when I say like the math is very complex, that's a very good example. And it also illuminates why a lot of quantitative firms, they like to hire physics majors, physics PhDs, physics master students, because a lot of those equations are, almost one-to-one, especially in terms of this Brownian motion. Like, they use that to model the stock prices. And if you're working with physics, you probably have an intimate understanding of, that equation, that set of equations, and how to manipulate them. And like I said, that subject is just a whole another set of videos that we won't get into right now. But thank you everyone for looking at this little short TED Talk about options. And stay tuned for more. Thanks. Bye.